Welcome to the Accounting Trio Studio. We are diving into the labyrinth of IAS 19, Employee Benefits. It's a world of promises, probabilities, and the occasional Roman threat of physical violence. Let's start with employee leave benefits. When employees accumulate leave days, they are not just planning vacations, they are building liabilities for the company.
Sam, my legionaries are restless. They demand their salt and their grain now. Why are you scribbling in that ledger instead of opening the granary?
Calculation complete. Marcus, the probability of legionary revolt decreases by 14.2% if caloric intake is maintained. Sam, I have calculated the accrual for unused vacation days to the 5th decimal point. It is 412.00039 man-hours.
Thank you, Rob. Marcus, we are not just giving them grain. Under IAS 19, we have to recognize short-term employee benefits as an expense when the service is rendered. That includes wages, Social Security, and, yes, paid annual leave.
Paid leave? You pay a man to sit under an olive tree and not march? This is why Rome fell, Sam. If a man does not march, he does not eat. There is no accrual for laziness.
Error. Marcus, laziness is a human variable I cannot compute. However, the liability is certain. Sam, I have already deducted the sick leave probability based on the current plague statistics of the local region.
Actually, Rob, for short-term benefits like sick leave, we only recognize the cost if it is accumulating. If it is non-accumulating, we just expense it when they are actually sick.
If a man is sick, I send him to the temple of Asclepius. I do not accumulate his weakness on a scroll.
It's about matching the cost to the period, Marcus. If they earn the right to a break today, we record the debt today. Simple.
Welcome to the next episode. Defined contribution ends when payments are made. It says, we have paid our share. While defined benefit begins with long-term commitment, it says, we will keep paying no matter what happens.
Warning. We are approaching the defined benefit sector. My processors are overheating due to the infinite variables of human mortality and discount rates.
Finally, a pension. After 20 years of service, I promised my veterans a plot of land in Gaul and 3 goats. This is a defined benefit, yes?
Exactly, Marcus. A defined benefit plan is where the company or the general guarantees a specific outcome, but it's risky. If the goats die or the land loses value, you are on the hook for the shortfall.
I am the general. I do not fear shortfalls. I will simply conquer more Gaul.
Statistically improbable. The plan assets must be measured at fair value. Sam, I have applied a discount rate based on high-quality corporate bonds. The present value of Marcus's goats is currently 0.0004% of a Bitcoin.
This is the core of IAS 19. In a defined contribution plan, we just pay the premium and walk away. The risk is with the employees, but in defined benefit, we use actuarial assumptions. We have to estimate how long the soldiers will live and what the goats will cost in 30 years.
You mean I must worry about the health of the soldier after he leaves my command? What madness is this?
It is not madness. It is the projected unit credit method. I am currently simulating the death of every soldier in the Legion 10,000 times to find the mean.
Rob, stop simulating their deaths. Marcus, this is why most modern companies hate defined benefit plans. The liability on the balance sheet moves every time the discount rate twitches.
Remeasurements capture the volatility of pension obligations, but IAS 19 keeps them away from distorting profit or loss. When actuarial assumptions surprise accountants, OCI politely says, "Let me handle this one."
Sam, the scroll is bleeding red ink. You said the goats were worth 10 gold pieces. Now this Rob thing says they are worth 8 because interest rates rose. My soldiers are sharpening their swords.
Correct. The net defined benefit liability has increased. However, I have categorized the variance as a remeasurement. Logic dictates this should bypass the profit and loss account.
Rob is right, Marcus. Under IAS 19, we don't put these actuarial gains and losses in the main income statement where they would ruin our year. They go to OCI, Other Comprehensive Income.
OCI? Is this a secret treasury where you hide your failures from the Caesar?
Sort of. It's where we put things that are too volatile for day-to-day reporting. Once it goes into OCI, it stays in equity. We don't recycle it to profit later.
I find recycling inefficient anyway. Why use the same error twice? I have processed the service cost and the net interest for the profit and loss. The rest is buried in the OCI graveyard.
I like this graveyard. It sounds like a place where auditors go to disappear.
It's just for the remeasurements, Marcus. We still have to show the world how much we owe the veterans. We cannot just conquer our way out of a pension deficit.
Watch me, Sam. If the discount rate falls again, I am invading the actuary's village.
Probability of Marcus successfully invading a modern actuarial firm 0.02%. Their defenses include extreme boredom and complex spreadsheets, which Marcus cannot penetrate.
All right. Let's just finalize the disclosure notes before Marcus starts a war over a net interest calculation.